In this video, we're going to talk about the taxability of stock dividends. So let's say that you own 200 shares of stock in Gorilla Corporation and that Mr. Kong owns 800 shares. So combined, you own 1,000 shares. So that means that you have 200 shares out of 1,000. That means you own 20% of the company. Let's just say this is all common shares. And so let's say that Gorilla issues an additional 1,000 shares. So they issue 1,000 shares and they do a stock dividend where they distribute 200 of those shares to you and then 800 of those shares to Mr. Kong. So now you're going to have 400 shares. So you're going to have 400. And now Mr. Kong is going to have 1,600. So now there are 2,000 total, right? And you still, so now you have 400 out of 2,000, which is still 20%. So your proportionate interest has not changed, right? So you still own 20% of the firm. And so for that reason, this stock dividend is not going to be taxable. This is not going to be taxable income to you as a dividend, and it's going to have no effect on the corporation. The basis of the old stock, so let's say, so your basis was $1,000 over 200 shares is now going to be spread over 400 shares, right? So the stock, so you're going to have now 400 shares, and then the basis in those shares would be $1,000 for all those shares, right? So that's how we handle a non-taxable stock dividend. But it's not that easy because there's situations where a stock dividend might actually be taxable. And there's 5 broad exceptions. They're outlined under Section 305 of the U.S. Tax Code. And basically the theme is, with all of them, is that there's something happening that's going to change the shareholder's proportionate interest, right? Because the whole reason that a stock dividend, when the corporation issues you these new shares, the whole reason it's not taxable is because your proportionate interest has not changed. However, there are certain examples where you have a situation where there is a change. Let's just say that Gorilla Corporation had instead said, okay, look, I'm going to give you 200 shares, but then Mr. Kong, I'm going to give him the option to take 800 shares, or he could take $50,000 cash. Now that you've given him the option to take something other than stock, that has the potential to change the proportionate interest of the firm. Even if, in this case, Mr. Kong says, I still want the stock, in that case, it's going to be a taxable stock dividend. Now, if some shareholders were to receive property other than stock, so cash, a machine, a bottle of wine, whatever, while others they're receiving stock and their proportionate interest is changing, that will also cause it to be taxable. Let's say that, for example, you had Class A shareholders, and then you had Class B shareholders. And Class A shareholders, they received more stock, and then Class B shareholders, they got some wine. They got a bottle of wine. So now it's different. The people who got the stock, now they're going to have a higher proportionate interest in the firm. So this is changing the relative interest of ownership. And so that's going to be a taxable stock dividend. Also, if some of the shareholders receive common stock while other shareholders receive preferred stock, that's going to cause the stock dividend to be taxable. And just in general, just generally speaking, if the stock distribution is made with respect to preferred stock, it's going to be a taxable stock dividend, even if this is pro rata. Right? Even if everybody is getting the same amount of preferred stock, it doesn't matter. If it's pro rata, it's still going to be taxable unless there is an exception. Certain types of preferred, convertible preferred shares could qualify for an exception. Now, speaking of convertible shares, let's say that you receive preferred shares that are convertible to common shares. Now, that is generally going to be taxable. However, it's a little weird if 100% of the people convert, right? So if, let's say, you and Mr. Kong, you each receive preferred shares that are convertible to common shares, if both of you convert, then it's not a problem. It's not going to be taxable. Or if neither, so also if neither convert, so you could either have everybody converts or neither converts, it's not going to be taxable. I know that's weird because we just talked about up here with our first exception that if somebody has the option to take something other than stock, even if they don't exercise that option and they take the stock anyways, it's still taxable stock dividend. This is different. This is different if 100% people convert or 100% don't convert. So I know it's a little confusing, but those are the rules. Now, let's say that it falls into one of these exceptions where, and again, these exceptions are, if it falls into an exception, it is taxable, right? So the general rule is not taxable, right? So if it's one of these exceptions, then it's taxable. So if it is taxable, then there is going to be an effect on the corporation. Obviously, the person receiving the stock is going to be taxed. We know that. But the corporation is also going to be affected because, remember, their earnings and profits, their E&P is going to be reduced by the fair market value of the taxable portion of the distribution that you're receiving.